Welcome to the program. Today we'll talk about the market and whether you should sell everything. We'll discuss what's going on in China. We'll talk about plunging commodity prices and what it all means for interest rates and the Australian economy. I'm Marty Switzer.
I'm Peter Switzer, and we're mad about money.
We've only got 8 minutes and we're going to cover each topic in no more than 2 minutes. Pete, first topic, report released yesterday from a leading financial institution telling us that we should sell everything and move to high quality growth bonds. Your thoughts? We won't name them because they're looking for publicity.
Yeah, that's exactly right, Marty. Look, I can imagine why an institution would actually come out and say something like this. They may well have this, I think, a minority view. A lot of financial institutions like UBS and Citi have actually become more negative than they were, say, a year ago. But to say sell everything, that's a massive call. And I think...
and that could be, and that's probably coming from an institutional analyst who is looking to give advice to institutional fund managers or trading organisations that have a very different investment horizon to, say, the people that are watching this show.
Spot on. And in actual fact, it was the economics and rates team in Europe. And look, they're entitled to have their point of view. There are a lot of people out there in other institutions who have different points of view and haven't got the same media exposure. And when you say sell everything, that's a big call. So
we've had a tough time on the markets at the moment. Last 8 days have been down. We've lost about a bit over 7%. The good news was, though, we had a positive light last night in Wall Street. Started positive, went negative, but then fought back and was up 0.75%.
Yeah, that's what I liked about this, because if this, and look, RBS was the company that did it. The company went broke not long ago.
You're nicer than me. I wouldn't have given it.
Yeah, but I made the point that it went broke not long ago as well. But the point is this: that this kind of call is possibly right. But I wanted to see how Wall Street reacted. If Wall Street started off 200 points down and kept selling down, I would have had to say these guys are probably going to be on the money.
And the Shanghai Composite did actually end up slightly up yesterday as well. So that was a positive point. So what's your outlook then for stocks for the year ahead?
Yeah. Look, what's happened is...
There are a lot of people are negative at the moment, and that's not really in your DNA.
No, it's not.
What are you thinking?
But the thing is this, it is always about the valuations of a company. And if things are now looking more negative than they were 6 months ago, it's logical. Stocks prices have to fall. But it doesn't mean they stay forever, because the valuations could change in 2 months, 3 months' time. We're going to US reporting season now. We might get surprised on the high side, and all of a sudden sentiment will turn around. But we do need to see China come up with some better numbers or something, a policy response that makes people think this China slowdown won't be a hard landing. It'll be a reasonably good landing.
Well, that's a really good segue to talk about our next topic. China. There's been a heap of stuff going on at the moment. It's really been the catalyst to create this whole snowball of negativity. So. We've been dealing with issues. There was some bad data, but then it led to suspensions of the stock market, this whole circuit breaker piece. We then had to deal with things like the devaluation of the currency in China. But overall, what it seems to be is that there's a lot of mixed messages coming out from the PBOC, or maybe that's just the way a communist capitalist organisation communicates. And that as a whole has driven down the sentiment of the Chinese market and then also world markets as well. What are your thoughts?
Yeah, well, people have always been untrustworthy of Chinese statistics. And I guess that's one question mark. And then you've got some really smart people saying China is going to create a cataclysmic event, and that was picked up by lots of people. And if you're feeling a little bit vulnerable, it's a logical response to say, okay, I'm going to sell. Interestingly, there's a guy called Joseph Stiglitz, Marty, and he's a Nobel Prize winning economist. And he actually made a comment very recently on Bloomberg where he just said the China slowdown doesn't look like a cataclysmic event. It just looks like a slowdown. And so
which has been expected and priced in for a long time. It's all been, the whole message coming out of China was that they wanted to rebalance their economy, and they're still forecasting growth of somewhere between 6 and 7%, which is pretty strong growth. So it does seem
up until 2020. They're saying we'll be around 6.5 or 7%. into 2020. So they're not seeing a hard landing, but there is question marks over, as I say, the statistics and the ability for them to, and also there's a worry that maybe the banking system there is in trouble. But no one really knows how the Chinese can respond. We know they have enormous amounts of reserves, even those reserves, those foreign reserves are falling because they're trying to prop their economy.
There's also
up.
a strong view as well that the Chinese economy is very decoupled from the actual real economy, unlike other sort of Western markets where the market is a 6-month indicator for where an economy is going to be.
Yeah.
Where China, there's very few institutions involved in that market. It's very retail focused. It's very, very speculative.
Yeah.
So there seems to be a disconnect. And the data out of China is not that bad, is it?
No, it's not that bad. And it's interesting is that they're trying to reduce their exposure to manufacturing and they're trying to increase their services sector. So in that interim period,
which they have done.
But we look at the manufacturing data and say, oh, this is going to be a slowdown worse than we expected. But we're not adding in what's the potential for services.
And that's above a rating of 50, which is expansionary, the Chinese services PMI.
Exactly right. And so and also look at the fact that yesterday in Australia we saw that the tourists coming to Australia from China topped over 1 million for the first time.
Yeah.
So they're getting out there and they're spending different sorts of money with us. They're spending money in hospital, in hotels, in hospitality or whatever. Once upon a time they were spending it with our BHP and Rio. So I just think we're probably misreading the new Chinese economy, the transforming Chinese economy.
Next topic, the other issue that we've had to face over the last week, which was a staple of the back half of last year, was this constant fall in commodity prices, and we're now at historic or near historic lows. We've halved over 50% in the last 12 months for oil. Iron ore is down sort of 30, 40%, something like that.
Oil went under $30 a barrel on West Texas crude overnight, which is extraordinary. And there's a damn forecast out there by Standard Chartered Bank of $10. Now that's the problem. The speculation of where oil price is going is hurting this market more than where it really is.
Yeah.
And I think until there's a belief, it can only come, Marty, from the global economy. If the global economy starts to look stronger than expected, then the oil price should start heading up in the other direction. But at the moment, I think it's in the hands of speculators. It's in the hands of those people who determine the prices, the future delivery prices of oil. And these guys are really just making everyone spooked. And until there's some turnaround, or imagine if OPEC can actually get some agreement. Imagine if OPEC came and said, we've got an agreement, we're cutting back supply. That oil price would go through the roof.
Until there's a stoppage in the supply war, it's hard to see how the price can change.
Exactly right. Well, you need to think that the global economy is growing so strongly, there's a demand for resources. Once a global economy is starting to grow stronger, they demand commodities and commodities go up. But until we get convincing evidence of it, remember the World Bank cut world growth for this year from 3.3 to 2.9, but people leave out that last year we only grew at 2.4. So they're expecting a 0.5% improvement.
But how important until commodity prices can turn themselves around, it's going to be hard for the Australian market to climb higher, do you think?
I think so. I think we have to
Unless
see
we get
a bottom.
strong earnings in the US, which we can then follow on the back of.
Yeah, and I think if there's strong earnings in the US, that will probably give a greater belief in the US economic recovery, which actually could then mean that the demand for oil is going to be higher. But there are so many things going on in the oil market in terms of like shale oil, the rig counts, are they increasing, are they decreasing, what is OPEC doing? And I think maybe we might get a bit of a surprise this year that maybe in an economy like India becomes more important for iron ore, and maybe iron ore prices can sneak up a little bit. But remember, even if they go up a little bit, it will help BHP's share price because they're currently being priced, as though Armageddon's just around the corner. And
they are getting the benefits of the currency as well.
Oh yes, without doubt.
Which is coming down.
Without doubt.
Moving on, next topic. So what does this all mean for the Australian economy and interest rates? We've had a great run. Really, if we look at it, the data coming out of Australia has been very positive for the last 3 months.
Yes,
Employment, GDP.
And we get employment, unemployment this Thursday as well, which is going to be very important to see because there have been these accusations that the numbers haven't been believable. Marty, you look, one thing, and I've already written an article about this, I just hope that Malcolm Turnbull just doesn't even entertain the idea of an early election. The last thing we need is the kind of investors strike, the business investment strike that happens when an election is called. I think what we're going to see the first half of this year, we'll have a lot of stock market volatility that will raise question marks over the strength of the Aussie economy. But I think in the second half, I think the stock market will start to improve, and that will help an economy that's going to be getting better. I reckon the second half of this year we'll see a stronger Aussie economy in the data, and I think the stock market will start.
And what does this all mean for interest rates? And
so therefore,
interest rates. Home loans?
The question is this: before this bad start to the year, my view on interest rates was on hold until probably Melbourne Cup Day. And then because I think the economy was going to be looking so much better, the Reserve Bank could go for their first rate rise. I now kind of think because of this economic worry around the stock market developments, the Reserve Bank could be on hold a bit longer.
But they're biased towards easing still.
Yeah, there'll be a bias towards easing, but because I believe that this economy is actually improving, as looking at the growth numbers and the unemployment numbers, I think they'll probably raise interest rates sometime in 2007.
And with interest rates at record lows, it's a great time to refinance your home loan. If you want to do that, you should check out Switzer Home Loans, switzerhomeloans.com.au. We've got some great rates there. That's all we've got time for. I'm Marty Switzer.
I'm Peter Switzer.
And we're mad about money.